Namaskar.
Namaskar.
Once again, welcome you and very good evening to one and all present in the second day of our 3-day series of WEBINT on Ind-AS. Hope with the blessings of Lord Jagannath, you all are well during this pandemic situation. Today's resource person, respected CMA Mrityunjay Acharjee sir, Chairman of South Odisha Chapter, CGK Chapter, Raulkela Chapter, Talchen Ongur Chapter, Sambalpur Chapter, Jajpur Keonjhar Chapter, Bhubaneswar Chapter, and their team members. Past President and CCMs of the Institute, past Chairman of the Chapter and EIRC, Regional Council members of ICI EIRC, esteemed members and stakeholders. Chairman of the Chapter, CMA Mukesh Chobe, Chairman of CGK Chapter, CMA Lalit Kumar Misra, CMA Ajay Kumar Samal, Secretary of the Chapter, and all my professional colleagues in the Managing Committee. I, CMA Shaktidhar Singh, Chairman PD Committee of the Chapter, warmly welcomes you all to the second day of 3-day series of WEBINT on Ind-AS. Today we have with us most popular and known face to each of the CMA family members of Bhubaneswar Chapter, CMA Mrityunjay Acharjee sir, who will deliver on Ind-AS 115 revenue from contract, Ind-AS 12 account for deferred tax, Ind-AS 36 impairment of assets. Hope this will be another learning session for all of us. It's my great pleasure to introduce the today's resource person. Before that, I would like to request our official to play the Institute Anthem. All are requested to fold your hand during the play of Institute Anthem. Thank you. 1 minute. Now it is time to welcome and introduce today's resource person. I heartily welcome you, sir, on behalf of the Bhubaneswar and all other chapters of Odisha.
Thank you, sir. Thank you. And thank you, everybody.
Thank you. CMA Mrityunjay Acharjee sir is a fellow member of the Institute of Cost Accountants of India and did his MBA Finance from University at Chennai. He has also gone through the post-graduation program in management from IIM Bangalore. He was rank holder in final examination of ICI and company secretary. CMA Acharjee has industry experience around 25 years, including Navaratna PSU like Bharat Electronics Limited Bangalore, leading private sectors like Essar Steel and Delhi Stock Exchange. He is presently holding the portfolio as Senior Vice President, Accounts, Audit and Taxation of Balmer, Lawrie and Company Limited, Kolkata. He is a guest faculty of IIM Kolkata, University of Kolkata, PG Management Department, IASB Kolkata, Indian Institute of Coal Management, Ranchi, XIMB, Bhubaneswar. He is a member of Direct and Indirect Tax Committee of Bengal Chamber of Commerce and Federation of Indian Industry, Kolkata. He is a member of the Board of Studies of Netaji Subhash Open National University. He is also a member of the GST Industry Group of West Bengal from Chamber of Commerce. His published books are publication on GST, GST law and procedure on registration and migration, GST rules and procedures, sole author of book titled Direct and Indirect Tax Management, meant for graduation, post-graduation and professional course. He has authored a book titled Valuation Management, published by Book Corporation, meant for CMA Final and CA Final curriculum. Authored a book titled Operation Management and Information Technology, published by Book Corporation, meant for CMA Final and CMA Final Corporation. Thank you, sir, for accepting our invitation.
Thank you, sir. Thank you, sir.
We feel as you are part and parcel of our Bhubaneswar chapter. Before concluding, I would like to announce third day of the program on the theme Index 23 borrowing cost, Index 116 lease, and Index 37 provision contingent liabilities and contingent assets. And our resource person will be CMA Ramashankar Mishra, Manager Finance, Mangalore Refinery and Petrochemical Limited, Bangalore. All are requested to join with the same link tomorrow also. Without taking much of time, now I would like to request our young chairman, CMA Mukesh Chaubey, to address.
Thank you, Shakti sir. My namaskar to all present on the second day of 3 days series of WEBINT on Ind-AS. I request participants to mute their audio and video for better clarity. I, CMA Mukesh Chaubey, Chairman of Bhubaneswar Chapter, feel privileged to welcome you all again to today's WEBINT on the area to be discussed on Ind-AS 115 revenue from contract and Ind-AS 12 accounting of deferred taxes and Ind-AS 36 impairment of assets, organized by Bhubaneswar Chapter in association with all other chapters at Odisha. My honest thank and insightful gratitude on behalf of Managing Committee of Bhubaneswar Chapter and entire CMA fraternity at Odisha to the respected resource person on the occasion, our most known and renowned face. He is none other than CMA Mrityunjay Acharjee sir, for accepting our invitation in virtual platform.
Thank you.
As esteemed CMA participants, Dr. S.C. Mohanty sir, President 2013-14, SP Padi sir, Devasi Saha sir, and stakeholders, chairman and their team members of other chapters at Odisha. CMA Lalit Mishra sir, Chairman CMA Chapter, and CMA Shakti Singh sir, Chairman PT Committee. One of our victorious leader, CM Ajay Samal, Dynamic Secretary, and other professional contemporaries in our managing committee. I once again affectionately welcome you all. Acharjee Sir Association and love in extending his support in physical platform to Bhubaneswar Chapter is extensive. So I am personally thankful to Acharjee Sir for his all-time support to our chapter and expect similar support in future also, sir.
Yes, sir. Yes, sir.
Dear friends, एक साथ आना एक शुरुआत होती है, एक साथ चलना उसकी ताकत होती है और एक साथ रहना जीत की निशानी होती है. हमारी ताकत आप लोग हैं जो कल भी हमारे साथ थे और आज भी हैं और हम सो एक्सपेक्ट करते हैं कल भी रहेंगे. This support is encouraging and boosting our energy level to conduct such webinars. I thank to all from core of my heart for extending team support by joining today on the second day of 3 days webinar on Ind-AS. For information of the participants, tomorrow on session shall be taken by CMA Ramashankar Mishra on Ind-AS 23, 37 and 116. All are requested to join the program at 6:30 p.m. tomorrow in the same link. मैं आपके स्वास्थ्य सुरक्षित जीवन के सर्वशक्तिमान को प्रार्थना करता हूं. थैंकिंग यू. जय जगन्नाथ.
Thank you, CMA Mukesh Chaubey, Chairman of the Bhubaneswar Chapter. Now I would like to request CMA Lalit Kumar Mishra, Chairman of CGK Chapter, please address.
Good evening, everybody. My sincere respect to Mrityunjay Acharjee sir, the learned resource person of this August evening. We have since past, we have been listening to Mrityunjay Acharjee sir for more than a decade. Actually, we feel privileged, sir, to again listen from you on this contemporary topic, is comprising of 3 Ind-AS. All the CMA participants definitely would be highly benefited, and the changes that is being addressed in this arena, I think you will deliberate in a more from very practical perspective. Hope this is this continuous endeavor of this Bhubaneswar chapter along with other chapters for this series of program on Ind-AS. Definitely, it would highlight the impact on the professionals that will be beneficial for the in the context of our working atmosphere. I think all the participants must have been taking the benefit. Nice, nice presentation in the yesterday's deliberation. We hope again we will be more enlarged and enlightened today to after getting the inputs from Mr. Mrityunjay Acharjee sir. Definitely Mukesh Chube and my colleague Saktidhar Singh along with the managing committee of Bhubaneswar chapter. Since last pandemic, since started from March for a continuous 9 months period, they are taking all steps to conduct this kind of programs, which are beneficial not only to the stakeholders but also the CMA fraternity. This is very very contemporary, and this is actually required because we do not make interaction on a day-to-day basis, but through this platform we are obliged to get much information and more enlightened on different issues. This is again once more I would like to extend my sincere thanks on behalf of the CJK chapter and all other chapters for the nice endeavor of the Bhubaneswar chapter. Okay, thank you all.
Thank you, CMA Lalit Kumar Mishra, Chairman, ICAI Bhubaneswar Chapter, for sharing few words. Now I would like to request our today's resource person, CMA Mrityunjay Acharjee sir, kindly address, sir. Over to you, sir.
Yeah. Very good evening.
Very good evening.
Satyajit Mukherjee, am I audible? Sun pa raha hai?
Yes,
right,
sir.
Very good evening and namaskar to everybody. Mukesh ji on the chair and Shaktidhar ji on the no. There is now there is no physical dais. No, it's like a global platform and everybody is there. So thanks to everybody, and always my sincere regards and thanks to Bhubaneswar chapter, because this is the place where really knowledge becomes vibrant. The knowledge becomes wisdom, and professionalism merges with the wisdom. Mukesh ji, it's my privilege, I should say, repeat it once again. This subject, when in our country, I'm not speaking about anybody or any particular place specifically, but when nobody thought about this emerging new accounting standards, somewhere in 2006-7, 12 years, 13 years back, I had that opportunity, and Mr. Padhi sir, my great friend sir, Shiva Padhi was the person behind that time who took out the subject called IFRS. Long backstory, and then the country has seen a lot of changes. The country has seen convergence. The country has seen how the accounting paradigm got changed. A profit-making organization overnight becomes a loss-making, and how a loss-making organization can be stretched into a positive net worth through this accounting. I should not say the word jugglery, but the accounting paradigm which brought in our country in the name of Ind-AS, which is virtually IFRS, global standard. And if I still recall the enthusiasm that I have seen some around 14 years back at Bhubaneswar in a dense rainy day, people who are now members were attending in such a crowd for this program is, yes, today also so many people, so many members are here. So that's my initial feeling. I should feel that I should share. Sahar sir is also there. All renowned senior members are here. So my sincere gratitude, my sincere regards and thanks to everybody. And with that, let us not waste any more time, because physical program we can stretch, virtual to what extent we can stretch, I don't know. To take out the subject accounting standard always is very, very monotonous. But let us make it as much as practicable so that we feel on this Sunday evening, we can at least say at the end of the day that yes, it is a real Sunday evening, right? To have a chat, have a discussion, good Sunday evening we have spent. So next 2 hours, or say rather specifically 1 hour 45 minutes, that much time is available with me. I slot it in the way, first 1 hour we should take on the 115, that is a contract and the revenue generation or revenue recognition from a contract, and then half an hour for the two, and obviously taking putting some time slot for the questions that that definitely would be there or definitely are there, and requesting my professional friends that questions relating to that, please keep it ready. Next 45 minutes or so, I will request all of you to share your questions first on 115, and then we'll go ahead. That's my agenda today. And yes, obviously, Shaktida ji is here and everybody is here. Whenever you feel that some modification or amendment need to be made, please feel right. Koibar pai apnara, so that I can start sharing according to the requirement. Coming to the first on first, right? 115 and what actually happens? Let's before going into the PPT presentations, Shaktadaji, this PPT I will share it with the institute, and you definitely know this copy. You share it with the members,
Yes,
which will
yes.
definitely help them in future references.
Okay.
So done. So let's go ahead. What actually revenue is something like revenue. So why people are crying? Why we need a global standard? And then why so many changes are taken place both in the accounting frontier as well as in the IT frontier, because without a IT, accounting is absolutely zero. So how the IT, how the SAP or even non-SAP, some ERP system, wherever you are working, how that ERP to be configured with reference to this revenue recognition becomes the biggest challenge. But people ask, पूछते हैं कि why you are asking so many things? Revenue is revenue. You go to a shop, buy a product. So whenever the bill is raised, the sale is booked. And if the money is received immediately, it is a cash sale. If the money is to be received after 2 months, then it is a credit sale. Most of the industries are going into the credit sale model. So there is a sundry debtors, and if you are able to collect the sundry debtors, good. If there is a some question, you go for a provision called as a provision for bad and doubtful debt. After that, if you do not able to get the money back, write it off. That's the model India or all the industry is to follow for over the years, right? But a question came out that are we really exhibiting the exact amount of revenue? So let's take 2, 3, 4, so many examples. Lalit Mistaji has already raised a question before we commence the official program. I will take up such questions, rather more questions on for clarification. But let's understand it, sir. One very, very simple question. I am going to, or say Shaktida ji is going to purchase a air conditioner, right? Or a freezer or anything for a car, motor car, right? Diwali Mosam has just gone out, year end going on, so many advertisement. So Shaktida ji feel tempted and go to a showroom of a Honda or Suzuki and ask for a particular vehicle. The vehicle cost is say 7 lakhs, and which says that it includes 1 year warranty, right? The shop owner says, the dealer says that, sir, why not you are paying another 50,000 or say another 1 lakh and get 2 more year warranty. What type of warranty? A complete and comprehensive warranty. Okay, very good, very, very tempting. So in case of any durable item, so the question comes out, it's not the raw material, it's a durable item. You normally we go for some sort of a warranty, right? Whether it is embedded price means price which is embedded into the main product price, or it is separately charged for a particular period or maybe a extended period. Now, take the example, the dealer of a Suzuki Motors in Bhubaneswar billed rupees 8 lakh to Saktidarji, and given the bill, given all the documents, everything, and the car key with which he just driven the car out from the showroom, and the car become his own car, right? He may use it for his personal, he may use it for his official. If it is used for official, some other issues will come out about the expenditure recognition. I'm not going into that. I'm going into that how this 8 lakh rupees for the bill amount exactly paid in cash, maybe over a draft or a credit card or no bank transfer or any other thing, but the money transferred from Shaktidarji to the dealer of Suzuki Motors. Whether this 8 lakhs rupees is an income, is a revenue of Suzuki Motors Limited, that particular, Bhandari Automobiles or Suzuki Motors Bhubaneswar or any other, for the financial year 2021. That's the question. Normally, all of you or all of us has got an understanding that the moment the bill is raised, invoice is raised with GST, right? Why I'm emphasizing the word GST? Because, after some time, you all are going to raise this question, right? Because GST is on the transaction, on the value of the supply. Here, the supply of the goods gone out. GST is collected and to be deposited to the government. My question is from the accounting frontier, that how much money, how much revenue to be booked for the financial year 2021, present financial year. Now, as per the earlier accounting standard, answer was very simple. Answer was your 8 lakhs is your sale price, 8 lakh you book it in your profit and loss as a credit item, and that becomes your income, and that should be shown as your revenue, right? Gross revenue. And the down the line allocation, appropriation of the revenue, adjustment, set off, then direct tax, then indirect tax, all clubbed with that particular 8 lakhs rupees. This standard, which was globally followed, definitely has got some merit. The merit says that if the 8 lakhs rupees is recognized as an income of the current year, then what will happen to the next year? Because there is 1 year warranty along with that particular product, which is embedded within the price, and you have paid 2 more years price at upfront on the beginning day, right, on the 0 day. That means,
excuse me, sir.
Yes.
Sir, you have shown your PPT?
PPT, I've not shared. I just 1 second,
okay,
sir.
okay.
Very good.
Okay,
Hold the line, sir. This is a real challenge now for me.
The PPT is not share, sir.
नहीं अभी शेयर नहीं किया, सब भूल गया. 1 मिनट सर.
Okay.
ये तो प्रॉब्लम है ना सर, वर्चुअल में. दिस इज वेयर आई एम स्टक. Please check whether it is coming or not.
It is shown, sir.
It is shown, no? Very good, very good, very good. Thank you, sir. No, please navigate and guide me, because a lot of time, if the PPTs, some problem comes out or voice or something, please tell me. Okay, done. And come back to this example, and then I'll move into the PPT. Or let's see what the PPT move. Yeah, PPT move nahi ko kar raha. One second, sir. Sir, visible?
Sir, yes. Now it is moving.
Now it is not. One second. I just take this screen at the side. Okay. Yeah. Screen is visible. So
Yes,
the
sir.
age-old practice that the movement, the ownership and the risks and reward is transferred. See, the Sale of Properties Act, the Transfer of Goods Act, or any of the act, even the sales tax law, VAT law, GST law, they have a basic conception that the sale price shall be the value at or against which the product is transferred. The risks and reward in the ownership is transferred, right? Then a question was altogether remain silent. So I repeat all of you, my professional friends, today's this program, please keep at least a white paper with you and a pen or pencil so that you can just note down the significant things. PPT definitely will be shared, but we have got a normal habit of forgetting the discussion. So please note down that very important issues. The age-old practice was the revenue recognition the moment the risks and reward in the ownership is transferred. आपने दुकान पहुंचे, you ask for a packet of some product, maybe a color television, or maybe a fridge, maybe a car, maybe your even raw semi-finished goods, right? Equipment, I will say a generator set for your factory. And the moment the risks and reward is transferred, that means you took a delivery of the goods, the sale is completed. So if there are tax practitioner, the indirect taxes, so many Supreme Court and High Court judgments were earlier period, that if a person takes a delivery of steel from Tata Steel's plant at Jamshedpur, Jamshedpur, and then take the material to his or her home state, maybe at Chhattisgarh, or maybe West Bengal, or maybe Assam, right? The transfer of ownership already had taken place. But now there is another suffix has come. Please read. Right, has been transferred to the buyer, and the seller retains no effective control. No effective control. That means the seller doesn't have any sort of a right, duty, and obligation. I repeat the word right, duty, and obligation in respect of such transaction. And that's precisely is a situation where the Ind-AS 115 comes. So makes it a very simple thing, makes it in a very simple way that out of that 8 lakhs rupees, if 6 lakhs is the price of the vehicle and 1 lakh is for the, what is that called, that uh, warranty for first year, that means what is that first year? 2021 some portion and balance portion in 21-22. And then you have another 2 extended years, that is 22-23 and 23-24. The money has to be appropriated and revenue has to be recognized over this 3 period, that is a 3 financial year. The revenue has to be recognized, and the money that we have received, please understand, the money that we have received has to be appropriated in the name of current or non-current asset. Current, which is going to be matured within the period of 12 months. Non-current, which is going to be now neutralized or matured beyond a period of 12 months. And this has to be reviewed at every point of time, every year and date, that how much current converted to, how much non-current converted to current, and vice versa. So it means the revenue doesn't means a impact only in the profit and loss statement. The revenue today has an impact in the balance sheet, and current and non-current appropriation. By any chance, if this asset is a financial asset, then the more difficult propositions will come. That propositions calls as financial assets recognition and derecognition. Okay, for today's sake, I'm not going into the financial assets because that will make the life more and more complicated. Okay, now what will happen, my friends, all of you, please imagine next year that Maruti dealer or Suzuki dealer or Kirloskar genset, or say any equipment that you have purchased. Assume you are running a hospital, right? And you have purchased certain equipment from Siemens with 3-year warranty. Everything has the same conception. So here the issue is what is more competent issue over here, that how much you are going to recognize as a revenue in the current year, how much to be deferred, and then if you defer it, please recall and remember, if you are deferring some portion, most of the maintenance by anybody, any corporate for any product, no, these are made or carried out by exactly some outside agencies. So if you take an example of say LG or Samsung, or if you take the example of any of the medical equipment or any other capital machineries, or even uh, you know some of the high-end gensets for your factory, you will find it out the company has engaged some OEM or the company's authorized representative service center or service provider in your particular state or particular city. And whenever these fellows are providing you services, they are not going to take money from you. They are going to bill to the company at a fixed rate, and there is an expenditure that also need to be booked. Now take the example of Kirloskar Gensets or Kirloskar Company Limited. Now take the example of Maruti Suzuki Limited. Take the example of LG. Take the example of Samsung or similar other thing. In all these cases, what comes similar is that that the transaction which needs to be rolled over to the next year or next to next year, revenue to be recognized in that particular period and not now. That's the biggest question as on today. Partial completion method, which is just presently being shown on the screen, I will get back. This is a very complicated issues in respect of a construction contract. Right, I recall just before we commence this discussion officially, we already had a discussion, but this is a very difficult proposition that in case of a construction contract, whether it is at Paradip refinery or a highway project or a railway project, that to the extent the percentage completion method is being followed for the purposes of revenue generation, if any amount is received beyond that, and that need to be identified in relation with this particular standard. I will come back to this after some point of time. Please have a look only on the graphical portion. In this, the earlier standard 9 or 18, they only used to say transfer of risks and reward. You came to shop, take your product, went out, finished. That is, revenue is booked. Today, it is not the revenue, it's not the risks and reward, it is the transfer of control. What does it mean? It means that you have got an effective control. Your warranty period of a vehicle is over. You took the vehicle to a roadside mechanic. The roadside mechanic can do any damn thing, good, bad, ugly. It's not a question of the company, because company doesn't have any, company means the manufacturer, original manufacturer, doesn't have any control over there. But the vehicle or your air conditioner or your refrigerator is still under OEM maintenance contract, 1 year, 2 year, 3 year. And by any chance you called a local fellow to repair it and some damage had taken place, the company, the original equipment manufacturer, will simply say, sir, the warranty condition is violated, my obligation is terminated. Am I correct, sir? My obligation, I'm not going to provide you any more services, because the condition of the warranty was that you should only get it served by our nominated or authorized person. That's called control. So if control is going to be exercised, for which money has been embedded, directly shown or not directly shown. What is directly shown? If it is shown, the equipment price, 1 year warranty, 2 year warranty, very good. If it is not shown, which is the most likely situation, then you have to understand, you have to value it. What is the value of that revenue for next 3 year warranty? And that has to be apportioned in the subsequent period. Done. I've got few examples to come to clarify these issues further. And before coming to that examples, once again, to remember two issues. Issue number one, every contract is a separate identifiable contract in this standard. Every contract, you need to identify every contract separately. So if you become an internal auditor, our members are definitely becoming internal auditor in number of places. Our members are definitely there in all the industries on a pan-India basis. Beyond India, I'm not speaking. On a pan-India basis, every category of industries, where accounts is subject to be audited by stat auditors, CAG, etc. We have to be meticulously very careful about this sort of issues. Now let's take this issue here once again. What happened? The model says, this standard says, you have to follow 5-stage recognition model before you close this, before you say that this much of is income is my revenue for the current year. And the balance portion, obviously the balance portion will go into the current or non-current. My friends, not now. When I'll be discussing on the Ind-AS-12, that is the deferred asset and deferred taxation, this becomes one of the ignition point, that if I am deferring some revenue with a certainty that the income may be, the income should be recognized in next year, that will be another Pandora box for discussion on the deferred tax asset and neutralizing by deferred tax liability in Ind-AS 12. Not now. Do not complicate the life. Let's take one by one. Number one, you need to identify the contract with the customer. So if a customer is having multiple contract, it's like you are entering with a contract with Indian Oil Corporation Limited, wherein you are going to provide 6, 7, 8 type of services or product to Indian Oil Paradip Refinery. In that case, you cannot say my customer or my vendor, it has to be one-to-one link. Every transaction, every contract has to be read in isolation separately. Then point number two, identify the performance obligation of the contract. What is the performance? Please read the word very carefully. Identify the performance obligation. What does it mean? Obligation means for which you are obliged to do the job. What are the things? You are obliged to provide warranty free services for next 3 years. Yes. It is written in the contract. Yes. That means your revenue has to be apportioned. 3. No, before coming to 3, please. There are a lot of performance obligations are there. I give you an example, that you buy you buy a printer from my company, from my shop, or from my brand. I am a printer seller, right? And if you buy this, next 2 years, how many number of time you change the refill, that printer, this thing, what is called cartridge, the price of the cartridge will charge 50% less. Done. It will be more interesting stories. You buy, I'm just giving an example, requesting all of you to know industry specific questions. Please bring it out so that we can have one-to-one solutions. But take this example first. You purchase a printer. Printer definitely require a cartridge, print cartridge, maybe black and white, maybe color. And the company from where from you are buying it, maybe the company directly, or maybe the dealer, maybe the distributor, maybe the wholesaler, they're given a condition that the first year, all the cartridge, say 5 number cartridge is free. Next 20 number cartridge, right? And 2 year period, 20 number cartridge or 2 year period, whichever is earlier, you are going to get 50% discount, and you have given a pre-discount slip, right? Slip number 1, 2, 3, 4, 20. And this is given along with the pack with the printer. You come back home or come back office, keep that slips separate. Next 20 refill of the cartridge, or next 2 year, whichever is earlier, you are going to have 50% discount. Lot of marketing trips are there, lot of marketing gimmicks are there, strategies are there to push your product into the new, to penetrate the product in the competitive markets. In each and every cases, whenever your marketing officer is coming and telling, sir, please do these things, then you have a obligation. Very recently, there was a lubricant company in famous, let's say it's Castrol India Limited, British Petroleum. They came out, no, everybody's doing, it's nothing new. They came out that they put a sort of a, what is that called, QR code copy, duly laminated so that it doesn't get spoiled in the lubricating oil, putting it inside the dabba, inside that the packet, okay, 1 liter, 3 liter, 5 liter. And all the time, if you recall, you will find it out that the mechanic, if you take your 2-wheeler or 4-wheeler to a mechanic shop and ask for refill of the engine oil or the, what is that called, mobile or engine oil, whatever name we say, they, before you, they will open the lid of Gulf or Castrol or anything. They will open the lid, they will pour it, but normally they will never hand it over to you the dabba, that packet, that container, that plastic container. Just throw it. You as a customer also find that very good, they throw it out, it's a dustbin item. But that coin, what is that called, that QR code remains inside, which at the evening they take it out, they take that particular slip, and at the month they go to the distributor, and against that QR codes, scanning the QR code, they get a cash money back. So this is just one example I'm telling. The question is, you are the Castrol is selling that container at say 300 rupees, which includes, has an obligation. Now there is no point, nobody says, a knowledgeable person can always say, okay, I will bring that packet, I will, before me you pour it inside my engine and then give me back that container, I will take it back. Possible, sir, nobody denies. In that case, the obligation of Castrol India or Gulf Oil or anybody, Shell or Indian Oil, remains constant. They are bound to pay that much of money at a particular point of time. So what is the revenue recognition? 300 rupees you sold, right? And you are taking a responsibility or obligation that after or within say next 2 years, some fellow will come out with that particular slip and ask for a cash reward, maybe 20 rupees, maybe 40 rupees. In that case, you have to average out that how much such coupon you have poured in, what sort of a container, what is the average redemption of these coupons, what you have seen in last 5 years, based on which you have to take a clause into the revenue recognition to say that I have taken an obligation along with the sale. So if the sale price is 300 and my obligation for this coupon is so and so, I need to have the revised or amended revenue recognition. Sir and ma'am, am I clear on this concept? Point number 3 is the determine the transaction price. This is what I have just discussed. Transaction price is not your invoice price, sir and ma'am, is not your invoice price. Transaction price is the price which is prevailing, which is applicable for the current financial year, for the financial year for which the accounts is going to be prepared. Done. Otherwise, what happened? In the year in which you have provided all this sort of promotional item, you have a boosted up sales followed by a comparatively less expenditure, because expenditure going to take place in the next 1 to 3 years, and you are going to report a high amount of profit which is going to be distributed among the stakeholders. And next year when there will be a expenditure booking, then you will be losing into coming into the trap of business losses, followed by which ultimately results a very, very dark side on your organizational performances. That's precisely is the background of 115. Point number 4, allocate the transaction price to the performance obligation in the contract. I repeat, I will just take out one example so that all of you will understand. Allocate the transaction price to the performance obligation. Underline the word performance obligation in the contract. Sir and ma'am, every contract has to be reviewed in line with the performance obligation. And 5, last one, recognize revenue when done the entity satisfy a performance obligation. Only then you recognize the revenue, not totality at a point. So if it is 8 lakhs rupees, so for a vehicle with the 8 lakhs rupees 1 year warranty embedded, take it out. 2-year warranty is additional. You have to say 6 lakhs for year 1, 1 lakh for year 2, and then another 1 lakh in the next 2 years. And that's how, based on your performances or performances obligation for performances, you recognized the revenue. Same thing what we have just discussed. That's the different steps, same concept. I just come out with an example and then again come back to this PPT so that you understand it very clearly. Let's take a very simple example, and after that some complicated example, and obviously after that I will take your examples. Done. X enters into a 12 months telecom plan with Airtel. Let's take why Airtel, anybody. No, I should not take anybody's name. The term of the plan is as follows. A monthly fixed fee of rupees 5,000, and X receives a free handset at the inception of the plan. No, if you recall Geo long back, Reliance Mobile, or rather, I don't know, maybe so many people can come out this sort of a plan. Okay. In between, I've seen Epson. Epson came out with a plan. In Delhi, I've seen number of advertisement. Just take out a printer at free of cost. Only thing, the next 2 year, the cartridge you have to purchase from Epson. Right? So many people has got a provides an option that take a Xerox machine, photocopier machine, free of cost, with an obligation that for every piece of paper you get printed, you are going to share me 40 paisa for each black and white and 60 paisa for each color. Today, most of the corporates across the country are not procuring, are not buying copier machines. They are all going to this sort of a contract like with Canon, with other photocopier machines. So every such contract need to be reviewed in this manner. Done. So fixed charges of 5,000 rupees and you get a handset free. Done. That handset is also available in the market at a price of Indian rupees 25,000. And in that case, if you say that I do not require a combo plan where you stay in a hotel with breakfast and dinner included, not free, included, you say I go for a la carte, then Airtel says that the same handset is for rupees 25,000. In that case, the monthly repayment would be for rupees 4,000 per month. So you have got these two plans. Anybody can buy, anybody can have an option A and option B. Now let's take a case where option A is franchised. Customers are very, very, greedy. The customer, they find that, I'm getting a handset free of cost. So let's take that. In that case, how the revenue to be recognized? This is the example. Come one by one. Identify the contract. Yes, the contract is which contract? 5,000 rupees per month and the mobile handset is free. 2, identify all performance obligations and delivery of the handset, the service provision. Now, if the handset is not working properly within that span of 2-year time, there is a return back obligation also. That fellow will come, customer will come and hand it over to you, and you need to provide a new handset. So you have to keep a provision for that also, provision for, return back of the goods. There is a separate chapter for that. I will discuss that also if the time permits, that how to keep a provision for the goods which is possibly going to return back. So what is your your study, your statistical study, that last 5 years out of the goods sold, how many times the goods return back within the obligation period of time, within the obligation period. Number 3, what is the transaction price? 5,000 multiplied by 12, that is 60,000. Very good. But how much can I recognize 60,000? Say customer A stepped in. He says, sir, this is my PDC, post-dated check, or this is my cash payment, 60,000 for the entire year. You take the money, give me the handset, and 12 months service is free. Now let us read slowly. Point number 4. Allocate the transaction price. What is the transaction price? 60,000 to be allocated. Cash in which manner? So let us take part B portion. That means where I am not taking a combo plan, I am taking separate item. So handset is for 25. Please see the screen. Handset is for 25,000 rupees, and 4,000 rupees in a month for 12 months. That comes to 48,000. Put together, the person, the customer, going to pay 73,000 rupees for the handset and for the services. Now you are a customer, you go to the shop, Airtel or any other service provider shop, and you say, the salesman always will speak you, sir, you are paying over here 73,000. Why not you are going for a combo plan? And in the combo plan, you are going only to pay 60,000 rupees, only 60. So you are saving how much? 13,000 rupees. Everybody will fall over there. Everybody will opine for that particular model of 60,000. In that case, now read. If 73,000 is 100%, and you allocate it based on that proportion, 34 and 66%, 34 for handset, 66 for the network, for the services. And in that case, what happens? Sorry, some phone call came. In that case, this 34% and 66%, you allocate this 60,000 rupees. And for the handset, you have not billed a single paisa to the customer. Please understand, sir and ma'am. For the network, you have billed 60,000 rupees. Now comes here a question. Your revenue billing should be different for your revenue recognition in your books of accounts. Handset, it is 20,500, and network 39,500. Total put together 60,000. You may raise always a question that where is the problem? Ultimately, you are booking 60,000 in the profit and loss. But let us understand a peculiar situation. The Airtel is not a hardware, is not a mobile handset manufacturing and selling company. Is not. Airtel is a telecom service provider company. Airtel is a service provider company. So the income from operations, revenue from operations would be 39,500. And income from others will be 20,500. Your ratios of operating profit to the income, operating profit to turnover, operating profit or profit to operating turnover will become absolutely different, and that becomes the net impact of this recognition. But what happens within this example, or in this same example, if you put some addition, and the addition like, right, free maintenance of this mobile phone, free maintenance of this mobile phone, that also embedded. Uh, Mukherjee, can you check up some of the phone line is on where some small kids are crying? Hello.
Okay, sir. Okay, sir.
एक बार check कर लीजिए.
Hello.
Okay, thank you.
Yes, sir. It's okay.
Right. Thank you. So you have to recognize, the Airtel will recognize in this particular way. Now, this life, whether it is good or bad, why it is good? Because the shareholders are going to get a real picture of your revenue, real picture. Done. And the stakeholders going to get a dividend on an actually earned profit and not from an hypothetical profit. What is difficult? Difficult from two angles. Number one, every contract has to be reviewed. The accountant has to be very, very vigilant into it. He needs to know not only book what comes out from the ERP, what comes out from the SFT. He or she need to go into the merit of the contract and then change it accordingly. Done. For the auditor, whether it is the internal auditor or statutory auditor or even government auditor, life becomes more difficult, because 115 they need to recognize and they need to give a comment that yes, 115 has been properly followed. I think if you have understand this background of what is 115 and to what extent it is different from the existing revenue recognition standard, let us just go ahead to go back rather to some of the other issues. Okay. The steps that we have already discussed. Always remember obligation and obligation and obligation. This is the most important point. Uh, right. It's like the issues that comes out, that what are the rights into it, the entities. So what are the things that need to be verified? Number one, whether any sort of a performance has been committed or not. Whether any sort of performance has been committed in relation to this sale. Point number one. Point number two, the entity can verify the right regarding the goods and services to be transferred. What are the right and what are the obligation? Means what are the obligation? You know you have got a zimmedari. What are the right? That you are going to get the money on so time within so on. So if you do not get the money, then you can have right the right to go to the court of law, etc. This PPT which is coming before you. Now think about a transaction which is carried out with some sort of a lease transaction. Lease 116 will be discussed tomorrow. I'm not entering into 116, but let's take. I'm taking some sort of a hire purchase model, some sort of a leasing model where it is not an operating lease but it is a finance lease. That means I take a particular asset, particular machinery from a equipment manufacturer, wherein I am going to pay the money in say 3-year installment, and then I get the ownership after the 3 year. So I am the customer. Who is the seller? The question comes out, how much revenue to be recognized by the seller, if it is a finance lease or if it is a hire purchase transaction, and whether the impact, because year to year the changes in the interest rate on the amount still unrecoverable, still unrecovered. That means the amount, how much you are maintaining in the current asset and non-current asset, how much interest you are going to book, and how much discount that you are going to charge it off. These are all the things comes out in this question. Friend, before I move further, these are the main text of the standard. But before I move further, one important issue in the new accounting standards that's called Ind-AS, which let me clarify. I am very sure that all of you are absolutely aware, but despite that, I'm clarifying this particular point because this is also required for me while I'll be discussing Ind-AS-12, that is called Deferred Tax Assets and Liabilities. The concept called as OCI. OCI stands for Other Comprehensive Income, OCI. It may be income, means it may be a positive, it may be a negative. What is OCI? OCI income, OCI expenditure. This is a new concept after the Ind-AS came into our country, say from 2016 onwards. And by 2020, even NBFCs, non-banking finance companies, are also covered under Ind-AS. So everybody is covered today. Okay, unless you are a very small player in the market. So what OCI speaks, I just give you an example so that you get a clarification. I made a valuation for the gratuity amount payable to my employees as per employees benefit accounting standard. Earlier also there is no big change. Earlier the standard was AS15. Today also the standard says almost the same. It says that if there is a constructive liability, that means if there is an employee who joined today, when the person is going to be retired on attaining the age of 60 or something, you are going to pay him or her 20 lakhs rupees as on today, or maybe 40 lakhs or something, right? Some amount as per the Payment of Gratuity Act. So you are taking a constructive liability. But the question, whether the liability is going to be paid today, answer is no. The liability is going to be paid after another 20, 25 or 30 years when the person is going to retire. Done. But today there is a actuarial valuation based on which you are making a provision. Actuarial valuation based on which you are making a provision. And this actuarial valuation says that the amount which you are paying today, contribution, debiting PL and crediting to that particular provision account, provision for gratuity account, and then transferring to the gratuity trust, out of that amount, how much relatable and attributable to the current year, you book it. Just one second. Okay. Clear. Some audio, anybody is having disturbance audio? Right. I get back. OCI, to the extent the amount is chargeable or relatable to the present financial year, to be booked to the profit and loss account, right? The balance amount which is not going to be relatable to the current financial year, but for the future financial year, but actual valuation you are debiting on your PL account, that portion is also charged, but it is charged under the name of OCI, Other Comprehensive Income. And this OCI is going to be reversed or further escalated on a year-to-year basis based on the provision, etc. Now, why I'm telling the concept of OCI? The concept of OCI is also very important because what happened? It's not moving. Yes, because it gives a impedium to this entire revenue recognition, wherein your obligations, you have to identify how much obligation for the current year and how much obligation for the subsequent years. Okay, so there are certain approaches. I repeat whatever I've discussed. It's now coming into the black and white. It's like the performance obligation may be explicit, that means it is written. It may be implicit, that means it may be implied also. And it may also happen that it arises from the customary business practice. What is business practice? That you buy a So there are the practical example of Kirloskar, what is that called, genset, industrial genset, generator sets. Some practical questions came out before the accounting standard board, which precisely target this third one, that some sort of obligations are there which is not written, but you are very sure that this arises from the normal or customary business practice. So even as a business practice, it is there. You have to recognize that in your revenue recognition, and to the extent of that obligation, if it is even 5 rupee out of 100, that 5 rupee you have to reduce your revenue for the current year. 5 rupee has to be added as the income of the next year. That's precisely is the standard. To add certain more difficulties, whatever I told in a very easy language, if I put some more difficulties into it, see, you get 100, you receive 100 cash receipt, bank account, your bank BRS, bank reconciliation says 100 rupees has been received from the customer. Your revenue you're recognizing for 90 rupees. Am I correct? 10 rupees you are putting it in the right current asset or non-current asset, 12 month or more than 12 months. Now idiotic question is, this 10 rupee you are going to recognize next year, 21-22 financial year, right?
ଗୋଟେ जो ଆମର ଗୋଟେ ଇଏ ହଉନଥିଲା କି ନା ନା ଏ ଯୋଉ ଜୁମ୍ ଇଏରେ ମିଟିଂ ଇଏ ସେମିନାର ହଉନି କି ସେଇଟା ଦେଖୁଥିଲି ବସି Ind-AS 115
sir seminar ହଉଛନ୍ତି sir?
ନା ନା କହୁନ କୁହ କିଛି ନାହିଁ
କିଛି କହିବା ପାଇଁ sir?
ହଁ
hello hello okay now interesting part, all of you please remember, recall and come back to me with your question. 10 rupees you are keeping aside for the next year to be recognized, sir, ek saal mein, in 1 year definitely there will be a inflation in the country, definitely. And the 10 rupees of next year, when you are recognizing today, the concept of net present value, you have to at least discount by say 8% or 10%. So 10 rupee will not remain 10 rupee, it will be say 9 rupee because of the inflationary impact. So if you actually want to book next year 10 rupee, to the extent the discount factor, you have to top up that 10 rupees. So that becomes another question, that to the extent this OCI, other comprehensive income, you are booking in the current financial year to be recognized in the next year, you have to be very careful that proper discount and interest is booked there also. Okay, then that's what I told. That's what is called as time value of the money. Each and every transaction in the step 3, in step 3 what I told, we told that in step 3 we have something called as the transaction price, determination of the transaction price. Sir and ma'am, extremely be careful that any such OCI, other comprehensive income, which to be recognized next year or after next year, you have to book it with proper discounting rate disclosed in the accounting standard and with proper interest rate. And what is the interest rate? The interest rate should be the GSEC amount. The interest rate should be the GSEC, the government securities amount, rate of interest prevailing. Okay. Some interesting part over here, if you can find it out, the last part point, non-cash consideration. Non-cash consideration. What is that non-cash consideration? It's like that lot of people, lot of organizations, this is a debatable issue, very debatable issue, that if there is an incentive for sales, that some medicine manufacturer, Ranbaxy, given an incentive to the wholesaler, that if your sale amount exceeds more than 5 crore or 50 crore, I will provide you this thing, Switzerland trip free of cost, a family trip. So whenever Ranbaxy is selling that particular product, and there is a doctor who is going to prescribe, there are wholesaler who is going to sell, you are giving some incentives for that. Whether the incentives should be treated as an expenditure, or the incentives, whenever you are thinking about the incentives which is going to be matured next year, right, should be embedded in the revenue transaction, is a question which today is being discussed. Right, this example we have seen. Now come back very short that when the transfer and transaction is absolutely getting over, this is we discussed on with some of the examples. We have already cleared it, so I'm not taking any time into it. Right to use and right to access, etc., that we have told. Here, important judgment on the accounting standard, not judgment, opinion of the accounting standard has come from 2019 onwards. Uh, is that the software? I give you an example. I give you an example. And obviously I require all of your views into it. What is the example? Example is, you purchased a software, Raman sir, in your organization, in your office, you purchased a software, maybe SAP license, maybe some sort of a manufacturing software, maybe some sort of a operating software, okay, which has got multiple phases of it, multiple check and balances, everything is okay. And then the software, whenever you are procuring, means you are selling a software, with that you are also selling a right that you can take a AMC from me, right? Because software cannot operate without a proper servicing thereof. Hardware is backed by the software, and software is backed by the AMC. Now, if you are a seller, like your company like Cisco, okay, there are millions of examples coming out, millions of questions coming out. Every questions are different. Cisco is selling a hardware for a networking, but for the firewall protection and all the digital check and balances, there are certain other, Robert Bosch is providing the security checks. Cisco and Robert Bosch has got a revenue sharing tie-up. They are providing a product where you buy a Cisco router or Cisco some hardware, and backed by a Robert Bosch control mechanism, and the AMC is provided by some of the third party AMC, which is authorized and recognized by Bosch or by Cisco. In that case, the end customer, let us say it is the Odisha Mineral Corporation Limited, is buying that product with say 2 crore rupees, with a combination of hardware, combination of software, combination of AMC for 3 years, and combination of a obligation that in case anything fails, PwC team, which is our back end team, will provide you 100% 24/7 services. That's precisely is the point of revenue recognition. If you read it on the left hand side, the point of revenue recognition, and if you read it on the right hand side, revenue recognized over time. Sir and ma'am, are you able to see it? Please understand the difference between these two. One is revenue recognized at a point in time. That means the moment transaction is over, your sale and purchase is over, the revenue is recognized. Abhi kya hai? From 2018-19 onwards, this second year going on, is the revenue is recognized over time, underline, double underline, triple underline. What is overtime? Overtime means wherever there is a right spillover of the obligations, spillover of the right, combination, right? And you have got multiple product in one basket, sir and ma'am, it's the timing issue, and you need to be very careful for that. Okay. What is the impact? What is the impact? Achha, before coming to this impact analysis, I will take out 1 or 2 example very fast. And recall, today it is not the subject. Today is not my agenda is not permitting, but all of you, as an accountant, professional accountant, we cannot only say, sir, this is why Ind-AS 115 is over. No, sir. We need to keep the other laws provisions in our mind, the SEBI regulations, the disclosure requirement, the LODR, and then in income tax, there is something called as ICTS, income disclosure and standards. Now, in this ICDS also, there are some overlapping situation. Wherever the upfront, the time setup, I give you an example. Let's take you and give you an example so that all of you can come out with questions. There is an organization, is you have some extra or spareable land space or a floor space in your business place, and you want to give it on a long-term contract to third party. Okay, so let's take an example. Take an example. ITI Limited. The old name is Indian Telephone Industries Limited. This is a practical case which has come to for suggestion, opinion before the Accounting Standard Board of MCA. And MCA, definitely they have got some expert panel groups. Obviously, our other institute is also there. It came by routing so and so. No, I'm not going into that details, but let's come to the example. ITI Limited is having a huge floor space at a very notable place in Bangalore. In Magadhi Road, they have got, in the heart of the city, they have got a huge land, means floor space. Absolutely idle because the company is suffering huge losses. Most of the offices they have closed. So they want to give it on a long-term lease. Right. Similar examples are everywhere. You will find it out that Odisha Industrial Development Corporation might be or definitely are giving land to the industry houses for a longer period, say 15 years, 20 years, 30 years, etc. And there are some monthly rent, very negligible. There is an upfront, premium. Sir and mine, I repeat the word. There is an upfront premium. That means when ITI Limited is handing over this floor space of the 10,000 square feet to a software company, say Crane Software Limited in Bangalore, they asked for that 10,000 square feet area. The annual rent there will be so and so, say X. The lease period is for 10 years. And for the 10 years, they asked for an upfront premium of 100 crore rupees. Okay. So in other words, it's that, absolutely cash crunch company, ITI. They wanted to take some cash to bail out some of the obligations. Very good. This listens very good. Questions or the problem is how to account it, how to book it. Can ITI Limited book this 100 crore rupees as a revenue for the very first year? Bank balance, bank transaction, BRS, the money has actually reflected. You got the money. Then, what is your opinion? Should they recognize as an income or revenue for the year 2021, current financial year? If it is not, if it is yes, answer is over. But if it is not, if you say no, sir, this income is you have received the money. So receiving of the money and income are two different denotation as on today. Both are not same. You are taking the money for an obligation which is going to be covered for next 10-year time. So for 10 years, you have to provide the services. Your area is going to be used. You need to spread it over according to this recognition model. So that means wherever you have a upfront income, whether by salami, whether in the name of one-time payment, zero deposit payment, so many names in the commercial world, your revenue recognition has to be very carefully drafted. Okay. That's what we have discussed, some of the question. I just told this particular example where upfront premium that you have received. There are situations where you can have very rapidly you can have this example. Uh, no, this example and other things will have a further discussion. Once again, please have a look that if Ind-AS 115 not been there, I take, let me just check how much time is available. Done. Within 2-3 minutes time, this example, very interesting example, that AB Limited enters into a 3-year service contract. So whenever, ma'am and sir, whenever there is a timing difference, more than 1 year, 2 year, 3 year, something which is going to be performed 3 years, something which is going to be obligation completed after 2 year, 3 year, 4 year, sir and ma'am, 115 becomes extremely important, extremely important. Why? Because you got a money where your obligation to be fulfilled after 3 years in 2023. Done. Two issues as an accountant we have to remember always in our mind. Number one, the money, value of the money, there has to be a time value of the money. Essence, time value, time essence. That means there will be a inflationary impact, commonly called as discounting factor, and backed by the money that you have already received. Definitely you would have you have utilized it for some purposes, either for some deposit, some income earning, or maybe you have liquidated your loan balances. In any of these cases, you you have either a direct interest income or a opportunity interest income, right? You had an old loan, you got the cash, right, mitigated the loan. That means your loan balance becomes zero, right? Had the loan been there, you could have paid. Agar ye loan rehte, you would have paid some amount of interest. Now no amount of interest to be paid. So you have got a notional interest gain. Both these things, discount and gain, has to be recognized. Now let us read. All of you are able to see the screen, no? So at the beginning of the third year, right, the parties agreed to modify the contract as follows. What are the contract now? The fee for the third year is reduced to 1,20,000, and CD Limited agreed to extend the contract for another 3 years for 3 lakhs rupees in each of these cases. Now the question comes out, whenever there is a changeover, whenever there is a changeover of the obligation and others, this, my answer something looks like that if 115 is not there, agar nahi hote, my revenue would have been the exact amount of cash that I am getting, exact amount of cash. But 115 says, no, sir, the shareholder has to be absolutely covered. Shareholder has to be given a dividend, which is the exact amount of income for the year. So that this year you got a huge amount of dividend, right? Share prices just jump up. And then with that, it has got a more amount of market capitalization. Everybody purchased the share. Next year, the share prices fell down because you find it out it is not that much profitable. So these are the peculiar issues which need to be covered and checked in 115. Very rapidly, let's have this 3-4 point. Remember, number one, the variable consideration and the constraint, expected value and most likely amount need to be determined. What is most likely? That how much is the discount normally you are expecting. I say in a contract, sir and ma'am, in a contract, say in a construction contract, or even a supply contract, erection, commissioning and supply contract, EPC contract, you have a clause like you provided a service, you provided a supply, you provided a goods, installation is over, but there is a defect liability period. That means you constructed a building, done a contract, and goes on giving the bill, what is called as running account bill, RA bill. At the end, the customer says, sir, your 10% amount I'm going to retain, because this 10% will be only given to you after the defect liability period is over, and this is normally we say as a retention money or retained income money. Done. I have provided, my engineers has given a certificate that entire job is over. And the contract value was 100 rupees or maybe 100 lakhs rupees, maybe 100 crore rupees. Can I recognize 100 rupees? Sir, I have also raised the bill. I've also raised the bill. Say 30, then 30, then finally 40 rupees bill I have already raised. That means full bill I have raised. Can I recognize in the 100 rupee or 100% in the current financial year? I have to recall, sir, I have to recall that contract said 10% would be retained, right? And that will be released after the defect liability period is over. So what is the defect liability period? Maybe 1 year, maybe 2 years. And two things may happen. Issue number one, if within this 2 year or 1 year period of your liability, your defect liability period, if anything goes wrong, you have to give a service, right? Complete replenishment without any additional cost. Is it an obligation? Yes, sir, it is an obligation. So you need to make a provision in 115 that yes, I can only book only 90% of the income and not 10%. 10% only after completion of that obligation is over. There is a second way of thinking, which is very difficult proposition in 115. That last 10 years, your production and marketing officials are very outspoken, and they said last 10 years, पिछले 10 सालों में there is no incidence where our money is locked or unpaid due to this defect liability period. And sir, you go ahead and book 100%. 115 says if you do it, you have to emphasize on the word most likely amount, expected value and most likely amount. What is most likely? No, none of the year we suffered with this obligation. So be assured, पिछले 10 सालों में नहीं हुआ, this year also will not happen. Please go ahead. You can book 100%. You can book 95%, provided you have all this measurement with you and you are ready to explain before the auditors and other parties. Okay, this is what the obligation, the examples I have already cited, discounts and rebate. Discounts example of that, QR copies, right? That also we have discussed. A wonderful example is like, sir, you take the goods, if you are not satisfied, right, return it back within 6 months time, free of cost replacement. Lot of situations are there where the sale is made with a strict, I should say, sales obligation or a marketing obligation promissory estoppel, that goods can be returned back if not satisfactorily performing within a next period of 6 months. And if it is, say, today 20th of December, you are making such a sale with a return back guarantee, 6 months falls in next financial year. Can I book the revenue? Can I book? To what extent I can book? Can I book 100 rupees as full revenue where there is a possibility? So again comes out this most common market practice or the industry practice or your old statistics. And that says the second line, which is highly probable. What is highly probable? So last 10 year statistics says 2% cases the goods returned. So you can take a call, 2%. Accountant are conservative. They says, no, sir, make it 5%. So 95% will book this year. 5% will book after that 6 months period is over. Listens very good. No, understanding is also very good. But if you come out with this sort of an examples, the working of it, the life of an accountant becomes absolutely nightmare. because each and every transaction you need to read, finding out that how much is an other expense, how much is the provision for sales. Please read it on the screen. And then each and every transaction you have to put the journal entry accordingly, show it in the books of accounts as OCI or as a current asset or non-current asset. And if there is a performance obligation, as a non-current liability. Both the things will roll on year-to-year basis. That's 115. Possibly these are the example. A lot of industry specific examples would be there. There are loyalty bonus that if you buy 1,000 pieces, you will be getting 10 pieces extra. How to book that income? Done. There are certain comparisons are also there, which earlier, but comparisons is no longer required now because we have already converged into 2018 onwards, already converged. We have to follow, and we have to keep this transaction very carefully. So whenever, my friend, anybody of you are going for an audit, please read this box 1, box 2, and box 3, the third one. Any difference in the revenue recognition, whatever we have discussed, shall be charged in the opening retained income or earnings. And that is the responsibility of the accountant to be covered. I think I'm overrunning the time for only one standard. Uh, uh, Mukashji, if you are listening, or Shaktidarji, sometime let this COVID situation get over. We should have this sort of a things like hands-on, some, what is that called, symposium, working on everybody with practical problems. So many practical things has come where Andhra Pradesh High Court given a judgment for Nagarjuna Fertilizer and Chemicals Limited that your accounting itself is wrong. So it was a prompted case by MCA, Minister of Corporate Affairs, and several such cases are coming up where MCA is directing that your accounting process is incorrect, your accountant done a wrong thing, and all comes with a basic understanding that 115 is not followed. Right, I'm coming almost to a close of my discussion to give a basic understanding what is the 115 and how it is having an impact on every case-to-case basis. Uh, Primarily, even everywhere it is applicable, but IT industries, that's what I told, the hardware, then software, then AMC, real estate means a long-term contract, and then what is that called? I told this, that's called your retention money or defect liability period. There are media and entertainment, media cases that if you perform that, you will be getting this much of money. And engineering and construction, most impact comes in this 4 industry. Most impact, engineering and construction, it includes aviation, long-term infrastructure, petroleum, etc. And we need to keep always in mind, sir and ma'am, please remember that whenever you read a revenue transaction, each transaction are separate, each contract is separate, and you need to read each contract separately. The watch shows something different over here, but yes, time for this particular standard is already over. I definitely keep my time with me so that we can discuss with uh, questions relating to this standard. That Mukashji and Shaktidhar Singh and others, who are on the dais, they can decide that when we can discuss this question. But I stopped sharing this PPT, shifting to the other one, so that we can rapidly complete the another 2 standard. And
there are some questions in chat box in AS115.
Shaktidarji, do one thing. We have time till 8:30.
Yeah, 8:30. Yeah.
8:30, no? So I will complete by 8:20.
Okay, then we'll go to questions.
We'll take all the questions.
Okay.
ठीक है. You being the moderator, अब मेरे को 8:20 पे 8:20 you give me a caution that it is 8:20 and then we have to take the questions.
Okay. Thank you.
Right, sir.
You can continue up to 8:25. Yes.
Sir, I still believe that questions would be for 115 questions will be more difficult.
And we can also continue, sir, 8:45.
Okay, okay. Let's that will do it. Not an issue.
Sir, we can continue till 8:45.
Okay, okay. So I'm coming to the next important one.
Okay.
Okay, more and very important one. Is the screen is visible, sir? No. Is it visible? Is the screen is visible, Shaktidhar ji?
Sir.
देखिए पर पाई sir screen টা accounting for Ind-AS-12.
No, sir. Screen is not visible.
Screen is not visible. Here it is. Your
Double
screen.
click to enter
No,
full
your
screen.
screen sharing is paused. ये क्या है?
Okay.
I repeat it. Your screen sharing is paused. Share screen. Then.
Yes, sir. Now
it is coming.
Yes, sir.
Okay. Shaktidhar ji, will you permit me? Can I have some tea with me simultaneously?
Yes, sir. Yes.
Chai.
No problem.
Okay. Okay. Sir, deferred tax. So, Ind-AS-12 done. What precisely this concept says? क्या बोलता है? What this concept says? What is taxes? We know taxes. You earn income and then we pay taxes, right? Income tax. You sell goods, you pay sales tax, you pay GST. But why there is an accounting standard called as deferred tax asset and deferred tax liabilities? At the very beginning, sir and ma'am, let me be very clear that this tax doesn't have any relationship with the income tax authority or GST authority or any of the tax authority. This issue is the only concern about the proper disclosure of accounting and financial recognitions. Give you an example so that we can go ahead with this subject. Is one of the most complicated. Rather, 115 was a very difficult standard, but easy to understand. But 12 is easy to understand, but difficult to implement. Why? See, the basic concept of the word deferred. Deferred means, what do you mean by deferred? You are deferring your liability, or it may be asset. You earn certain income, whether you are an individual or a company or BOI or something. You earn a profit, you earn income. As per the Income Tax Act, you pay the taxes. You have got a tax liability. You pay the tax by way of TDS or by way of advanced taxes, chapter close. That's called current tax, present tax. But where is the question of deferred tax? And this standard says only about deferred tax. So let's take one example so that all of us will understand. Sir, income tax, even today, Income Tax Act provides a higher rate depreciation so far as the product is concerned. So far as the Companies Act is concerned, Schedule 3, Part 2, Part 3, all the schedules of the Companies Act, which says that the PPE concept, the actual usable life of the asset. So if an asset has got a usable life, you determine in your accounting standard. Every company is now disclosing in their accounting standard that what is the life of the plant and machinery, what is the life of a building, what is the life of computer and other equipments. And based on which, if your the plant and machinery has got a life of 10 years and the value of the plant and machinery is say 10 lakhs, so your depreciation under Companies Act would be 10 lakhs divided by 10. Very simple today. But the Companies Act, the Income Tax Act has got a slightly higher rate of depreciation. And there are certain cases where we call additional depreciation, accelerated depreciation, etc., wherein the product is getting, the machinery is getting higher rate depreciation. Done. All of you are clear? Now, the net profit is drawn as per the Company Act, the Schedule 3, and the depreciation charged accordingly. When that net profit you start for income tax calculation, you reduces a higher depreciation amount. Why, sir? Because the depreciation rate is higher as per the Income Tax Act. So in the current year, first year, when you capitalized the equipments, there will be a huge amount of depreciation as per IT Act, and there will be comparatively low amount of depreciation as per the Companies Act. And that difference we claim as a benefit or deduction from my income to derive, किसके लिए? To derive my taxable income. So my taxable income become lower, my tax liability become lower. If my tax liability becomes lower, my profit after tax, PAT, become more fatty. It becomes, it enhances, and the shareholders get a higher amount of dividend out of that PAT. That after 2 or 3 years, assume 2 or 3 years, there is no further capitalization, no further booking of the new assets. So under the Companies Act, the depreciation remains constant. Whereas under Income Tax Act, your WDV value, acceleratedly it reduces, and finally your WDV value, becomes very thin, on which the depreciation amounts become very less. So take example, your that 10 lakhs rupees divided by 10 years, every year as per Companies Act, 1 lakh rupees is getting debited, depreciation. And it's under Income Tax Act, first 3 years, huge amount of depreciation. That's what we call the word depreciation allowances under Section 32, unabsorbed depreciation allowances under Section 32, subsection 2, etc. Okay. After the 3rd year is over, your WDV, the book value as per Income Tax Act is very, very less, whereas under Companies Act, it still remains. Done. So in the 3rd year, assume there is no further capitalization, 3rd or 4th year onwards, it happens a opposite picture. Ulta Roth, it becomes the opposite picture. Your 10 lakhs divided by 10 year, that is 1 lakh is added. And how much you are deducting? It may be 20,000 rupees you are deducting as depreciation under Income Tax Act, because your block has already reduced. So the first 3 years, you have got accelerated tax benefit. Next 5 or 6 years, you are going to pay for it. You are going to reverse the same thing. So the first 3 years, this standard says that you cannot deprive your stakeholders, shareholders, by giving a higher amount of tax, profit after tax for the initial 3 or 4 years, and then reducing it to 0. You cannot do that. The year you are getting tax advantage, to that extent, that additional amount, you have to make a provision, you have to make a liability, not provision, you have to make a liability. That liability called as Deferred Tax Liability, DTL. Why deferred? Because after the 4th year or 5th year, when the situation will be reversed, where your tax depreciation is less, accounting depreciation is high, in that case, you are exposed to more amount of liability. That more amount, the additional tax liability, will be reduced by that earlier provision, that earlier deferred tax liability jo bana the aap, that will be adjusted, that will be set off, and this setting of process is called as deferred tax asset. So if you put it in a blackboard, we don't have that facility over this thing. I don't have. If you put it like 10 years, book depreciation, 1 lakh rupees each in every year, tax depreciation becomes a spike. Initial 4-year very high depreciation allowances, then reduces. So first 4 year you will book deferred tax liability, the liability for the future year booked in the current year, and then in the bad days, that means after the 5th year, when your book depreciation remains constant but the tax depreciation reduces, then you bring from earlier year, like set of carry forward, you bring it from earlier year and net it off. It's called deferred tax asset. This is the conception which was prevailing under AS-22, and then from 2016 it becomes Ind-AS-12. Done. Now AS-22 and Ind-AS-12 basic conception remaining the same. Fundamentally, first part, there is a conceptual difference, I'll come later. First part is that if any differences which is temporary in nature, but before that, if there is any difference which is permanent in nature, then which cannot be reversed, means depreciation is getting reversed. So any reversible thing, whether it is a provision for bad and doubtful debt, whether it is a one-time provision which will be adjusted on a subsequent year, this sort of differences which are in the nature of temporary differences. I repeat the word temporary differences means today you have got a favorable difference, tomorrow it will be an adverse. Example of that depreciation that I have told already. I told while discussing 115 115 जब बात कर रहे थे, we discussed about OCI. What is OCI? OCI is the other comprehensive income. So any change every year, my friend, every year we revalue our employee benefits, the gratuity. Every year, if there is a valuation of a property, then whenever you change the valuation, the differential amount is booked as OCI, other comprehensive income. Now, which is to be adjusted over a period of time, And that's that particular point where deferred tax asset and deferred tax liability comes into the picture. Done. Now, now comes to a very important point over here. Ind-AS-12 comes out with a very interesting point. It says that, sir, it is not only the PL to PL. It is not a profit and loss account to profit and loss. It is not a tax depreciation, but vis-a-vis the accounting depreciation. But what is important over here is that you have to work out a balance sheet as per accounting methodology, as per Companies Act Schedule 2 or Schedule 3. From the tax point of view, you have to make out another balance sheet, another full set of books of accounts, considering the balances as per the tax balances. I just repeat. You have got a block of asset under the Companies Act, and you have got a block of asset under the Income Tax Act, block of asset concept. That considering this block of asset, your net profit or net asset value is determined. Net asset value, asset minus liabilities. Considering the tax block, your another net value is determined. The difference between these two is your deferred tax asset or deferred tax liability. The difference between these two is the deferred tax asset and liabilities. I've got a lot of examples which, my friend, you can go through it on a subsequent time. These are the examples. I just come to that presentation part. Have a look into it. Carrying amount means the value in the accounting base. What is accounting base? The accounting base means my accounting, how much is the value of the asset in my accounts. That means in the block of asset. And how much is the value in my tax block of asset, in the income tax block of asset on which I am charging depreciation. I am claiming depreciation benefit. ये दोनों का difference is called as temporary difference. Then say provision for diminution in the value of an asset. I repeat the word. The next standard, I do not know how long I'll be able to discuss, is called the impairment of asset. That means an asset which was absolutely good, but the government said that you cannot use this asset because it creates a pollution in the environment. So the machinery operation is stopped. Done. I made a provision in my books of accounts. But if I change, if I shift my factory from Cuttack to some place in Jagatsinghpur, and I reopen the factory by using the same machinery, the value of the equipment, I will continue to get the benefit out of it. In that case, the impairment would be reversed. So here these things happens. The accounting base and tax base ka difference is the temporary difference. Temporary difference multiplied by the rate of tax applicable is the deferred tax asset or deferred tax liabilities. So in short, the deferred tax concept says you have a full set of books of accounts as per accounting base, where your all provision, all liabilities, all assets are booked as per the Companies Act, done as per Schedule 2, Schedule 3 of the Companies Act. And you have your tax base. In the tax base, you calculate the net value of the asset based on which, based on what? Based on the income tax rates. And that income tax rate, you have the tax base that comes with the deferred tax asset and liabilities. So if you have deferred tax liability this year, that means a liability for the future year, अगले 3 साल के बाद जो liability होने वाला है, that you are booking in the present current year, which will be adjusted, netted off in that subsequent year, right? When there will be a reverse situation, so that shareholders get a uniform rate of return over the years, uniform rate of return over the years. That's the concept of the deferred tax. One of the really, this is a method how you should do it. Calculate current income tax, determine the tax base, calculate the temporary differences, and identify the relevant expenses, recognize whether it is deferred tax asset or deferred tax liability. There may be, and make a proper disclosure. There are so many areas which affects deferred tax assets and liabilities, but please remember, these are all the examples and case studies are there. Please remember that whenever you find there is something which is going to be rollover to next 1 year, 2 year, 3 year time, called as timing difference, temporary difference, which is not permanent in nature, deferred tax assets and liabilities are applicable. I've got some workout examples. I am not sure, Shaktidhar ji and Mukesh ji, upload some other day, some other time, maybe some workshop or symposium we can have a one-to-one examples, and then we'll have it done. I'm closing this particular one since one more is remaining. Done. Shakti, you keep me informed, because we should also keep time for the members for question here. So I'll take just take me 5 minutes time, okay, and then balance portion will take for the questions. Respected members, everyone, impairment is a concept which should be there in our country, in our country, in accounting paradigm. Should be there. Why? Because this is the concept which tells very clearly.
Sharing any PPT?
All the three, sir. PPT are not visible, sir?
No, sir.
1 second.
PPT is not visible.
1 second, sir. Your screen is paused. Kya, sir? What is this? I do it 1 second, huh?
Yes, sir. Now come.
Now come now? Yes, yes.
Yeah.
That's your control, sir. You unless you tell it will never come. Okay. Now, what is the impairment? Let's take what is the impairment and how to do it. Very simple equation. The shareholders across the country, they find that the balance sheet, in the balance sheet, printed balance sheet, huge amount of fixed assets are there, plant and machinery. Say 100 crore of plant and machineries are there in the fixed asset side. And if the fixed asset side, there is 100 crore rupees of fixed asset, plant and machinery, obviously on the other side, your net worth is also positive, because that is backed by, double accounting system, that is backed by your net worth, either by reserves or retained earning or something that like. In reality, it may happen, in reality, it may happen that asset is there, but the real cash generating capacity of the asset is lost. Then how it is possible? It may possible by so many reasons. Let's take an example. You have got a factory within the municipal corporation area of Bhubaneswar or Cuttack, and the equipment is now generating some amount of pollution. High Court Green Bench has given an order that you cannot have a machinery or a factory within the city level zone, and you have to go out to some industrial places, maybe Jajpur or maybe Talcher or somewhere. So what you did, you stopped the plant, looking for a land in Talcher, and in this process, 6 months or 1 year time is over. After that, you got a new plant, set up your factory, shifted this machinery, and after 2 years, you started doing the business. Now the question, at the year end, 31st March 2021, what you are going to show your shareholders? Are you going to show that it is 100 crore rupees of asset is there? Right? Shareholders will understand fixed asset is there. But what is this third line? What is this third line? What is the cash generating capacity of that equipment? Is there any cash generating capacity as of today, as on 31st March 2021? Answer is no. So if it is a no, then for this entire equipment, you need to make a provision in the books of accounts. So PL account debit to impairment of asset, and that will be reduce both the side. Your profit and loss balance, your profit will come down, and at the same time asset value will come down. It shows that the exact amount of profit that you are earning for the current year and no fictitious profit. That's the basic merit of Ind-AS 36. The 36 concept works with a concept called CGU, cash generating unit. That we say in a hotel, right? Say in Sosip hotel, you've got so many things together. There is a lodging, there is a fooding, there is a gym, there is a gymnasium, there is a swimming pool, etc., spa. But whether all are operating independently or they are operating together. Let's take an example. Some company has got 5 stores, Saravana. It's like a Saravana stores in Chennai and Hyderabad. Has got 5 stores, including, right, X wherein purchase, pricing, marketing, advertisement, all done from the corporate level. Done. Can X be a CGU? X means the corporate is a CGU. The individual businesses are cash generating unit. So whenever we compare a impairment issue, we have to look at whether it is a cash generating concept or is it a non-cash generating concept. So here the answer comes yes. So similar, a lot of questions always comes out. It needs to be valued whether the asset in use, there is an economic value of the asset or not. If the value is lost, then whether the asset is lost or whether the purpose of the asset is lost. For example, you have got an asset which manufactures wonderful machine. It manufactures floppy disk. Now today the floppy disk concept has gone out. Today everybody is using a data card or more advanced gadgets. So even a beautiful equipment called as, which is manufactured for the floppy drives, is absolutely impaired. So you have to say that I have the equipment, but the economic value of the equipment is zero. I need to make a provision for the entire amount. Okay, there are this is the table how it is being done, whether it is impaired or not impaired, depend on the actual requirement. And in the case you find it out that the value is, the equipment is not providing any cash value, you need to make a provision in the books of accounts. That's the crux of the issue. A question comes out that who is going and how is going to be the value, how to determine the value. That's a big question in impairment. And how the value to be calculated. Only issue which is very important, and the last issue for me today, is that you make a provision subsequently after 2 years that asset actually become, actually has been a revival process has taken place and the asset is now being used. Can I reverse this provision? So earlier entry was PL account debit to provision for diminution, provision for impairment. Can I reverse it? Answer is yes, you can reverse it in the year in which you are actually using this asset. You can reverse it, and that shows a reflection. Just last line before I close. This is also a place, also a challenge for our temporary differences. Whenever you made a provision, if you are sure that after 2 saal, 3 saal, you are able to revive this process, you should have a deferred tax liability and asset also, so that the stakeholders should not have an impact of it. In summary, what I only say that, sir, the accounting standards are not monotonous. It's a wonderful subject. Every transaction that we do, whether in the industry or in service or anywhere, should reflect the real professionalism from the A&F fraternity. And these accounting standards need to be read together. It cannot be in isolation. Thanks to the chapter, all officials, everybody, for taking up accounting standards, because yes, this is the place where we should keep more emphasis, so that we should also take the flag high and say that yes, we are a accountant within the definition of everything, not only for one purposes, but for every purposes. And then only I will just শেষ করে phone করছি। And that's it. There is a success of entire accounting standard concept. I come to the close of my this entire PPT portion. Now keep open, to the extent time permits, keep open for any questions from your side. Shaktidarji.
Sir, thank you, sir, for nice presentation and detailed deliberation on 3 accounting standards.
Yes, sir.
Specifically on revenue from contact. There are some questions in the chat box. First question is extended warranty period charges required to show separately in invoice?
Answer very rapidly, sir. Normally, if it is a business practice that any equipment goes with 1 year services, means post sales warranty services, you need not to show you, and nobody is showing it, but it is a business practice. So two, what comes out, one is specifically shown in the invoice. If it is an additional warranty, that is shown, because that is not a normal business practice. That is the additional. You take it of your own.
Okay, then next question from Bikram Kesari Das. Please let us clear which clause is Ind-AS-115 signifies the appropriation of revenue into operating income and other income, as you cited in Airtel example. Which clause
Sir,
in Ind-AS 115 is focusing on ratio of operating income to total income for recognition revenue in operating and other income when there is a combo offer
sir,
sold?
absolutely. This is like nowhere, absolutely this word operating and non-operating is nowhere written, but the disclosure requirement in 25.141516, if you read it in combination, because standard is, sir, one thing I repeat to everyone, standard is something like the formula of physics, and which is like the science, and the difference between science and technology is the application of that science. So whenever you are applying it for a particular application, it becomes technology. So the standard para 25 14151617, this gives this impediment of this concept. Application is whenever you are arguing with the auditor and you are arguing with the SEBI or MCA or other authority, that what is the disclosure requirement that is guided by LODR requirement. So sir, only do not look into the standard. Side by side, you have to also look the LODR requirement, the SEBI guidelines from time to time, and MCA circulars. That in conjunction gives you the total picture.
The next
Sir,
question.
sir, may I intervene, sir? Sir, actually, that revenue recognition, that 115 is focusing on that income from regular course of business on contract. So that means it is completely operating income. We cannot focus on that other income, but that, as you pointed out, that operating income and other income, that is separately discussed in, I think, Ind-AS 11 or 18, and that is
18,
not
sir,
appropriated.
18 is now merged with 115.
Yeah. Okay, sir. Thank you.
Sir, no, I'll review. It was a very good question, very relevant. That means I'm really happy that you have gone through this standard. Very good. Only the what I repeat to everyone, that accountant's role is not only accounting standard, not only LODR, not only MCA, not only income tax. We are expected to know everything. That's a challenge, or that's the opportunity. Shaktidaji.
Yes, thank you, sir. Thank you, sir.
Okay, sir. Yes.
Next question, same question from Vikram Kesari Das, sir. In 2019-20, my company tax as per income tax is rupees 1000. Carrying value of a liability in that year is rupees 100 more than tax base of that liability, and the difference is capable of being reversed in next 5 years.
Okay.
Tax rate say 30%. MAT is calculated rupees 1200 in that year. How will I recognize my tax expense, current tax, deferred tax, and MAT, and the amount in respect these in my profit and loss account?
Sir, Shaktidaji, what I can only request you, that this is something like a specific business question. You can send me from the institute, from the chapter, you send me a mail. I will answer it separately. Okay. This should not be in a public, because it is like some private data will be coming out in the public domain. I will definitely answer it. Not a big question, not a very difficult question.
Sir, actually, it is not a private data. It is purely one example I cited. Sir, it is conceptually, because what you discussed, sir, it is related to that Ind-AS, which focusing on that deferred tax, sir. So from that perspective, sir, it is a part of that Ind-AS 18 or deferred tax, what that Ind-AS is saying. I am talking about, sir, that recognition part, how that deferred tax will be recognized, how that current tax, how the tax expenses, how the MAT will be recognized in the profit and loss account, because we cost accountant are going to do audit, tax audit, or tax audit is not here. But
Vikramji, please, can MAT be recognized in profit and loss account?
No, never. That's it. Yeah, that's why I mentioned, sir. Balance it. I have mentioned, sir. Balance. Yes, sir.
Please do one thing.
That is not a. That's why, because, sir, it is purely that Ind-AS deferred tax, for which that interpretation of the tax reflected in the profit and loss account is to be highlighted in this forum, sir.
Absolutely. I fully agree with you.
Sir, just I have given only simple that number, sir. Not I have given any corporate
Not an issue,
that
sir.
amount.
Sir,
Yeah,
like,
1,200 like this I have mentioned, sir.
what is one?
But anyhow, sir,
one
very
thing.
good deliberation.
No,
Unless
no,
we will
you-
deliver it, we cannot.
Exactly. So
That is what I have tried to say.
you just send this query to chapter, and
Yeah.
I will definitely respond. It says no question, but only thing
But
is,
sir,
That
this needs to be discussed, sir. That is because
I
that is
equally
purely, yeah, sir. Okay, thank you. If anything goes wrong, sir, please excuse.
yes.
Last query is what is unbilled revenue as per Ind-AS 115, sir?
Anand, sir, what is the question?
What is unbilled revenue?
Unbilled revenue, the bill means revenue which you have not billed yet. That means a transaction which you have completed, say a partial completion method of contract, any contract, partial completion, you have completed, but that milestone has not come for a revenue booking. That means you are constructing, say, Nalco's a new smelter plant somewhere in Damanzari. And in the process, the construction, there are certain milestones that unless you complete this particular, say, conveyor belt and it is operating, you cannot raise a bill. So that's a milestone. Or milestone maybe, say, your bill should be raised once in every 2 months or 3 months. Every contract, every natures are different. So if the job has been completed, is successfully certified, and you are ready to make a bill, it's called unbilled revenue. Whether the revenue you should book it or should it not be booked. On a partial completion basis, there is also an accounting standard. There is also a cost accounting standard, whether I should book it or I should wait till the bill actually being raised. So that's a question of unbilled revenue or unbilled revenue booking. Very, very difficult proposition. It absolutely depends on every nature of the contract. So, Satyaji, whomever member has raised this question, if it is a construction related contract, then unbilled revenue need only to be recognized once the bill is raised, because here the bill comes later. The 115 all completion comes if the bill comes first and obligation next, then the problem comes more, which we have discussed. If the job is already completed and certified by both sides, it is only the bill is awaited because of the milestone. Sir, that is a much easier thing to do.
Thank you, sir. Now, there is no other questions. Before concluding, I would like to thank all the participants. I, on behalf of the ICAI Bhubaneswar Chapter, thanks all the participants, and my sincere gratitude and hearty thanks to CMA Mrityunjay Acharjee sir, Senior Vice President Balmer, Lawrie and co, for accepting our invitation and sharing valuable times and his thoughts with us. Thank you, sir.
Thank you, sir. And a lot of I'm getting a lot of very senior our members, my all elder brothers over here. Andir Jami sir is also here.
Yes, sir.
Thank you, sir. Thank you. Thanks, Shakti Mukesh ji, for this opportunity. Devashish Shah sir is also there. Wonderful. It's nice seeing all these names.
Yes.
Okay.
My hearty thanks to CMA Mukesh Chauve, Chairman of the Bhubaneswar Chapter and Chairman of all other chapters of Odisha, for their great initiative and cooperation. And my special thanks to all the participants for their patient hearing, and hope some same sort of support and cooperation in future events. This is the last, not the least, my special thanks to all the staffs of Bhubaneswar Chapter for their all-time support. Wishing you all a happy Christmas in advance. Good night. Jai Jagannath. Thank you, sir.
Jai Jagannath.